The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. I want to thank you for attending our webinar this morning, Quantum Profit Management. This morning I have Bruce Merrifield with me. He's out in Boston. Good morning, Bruce.
Morning, Randy. Good morning, everyone.
And I'm in Phoenix this morning. What we're going to be covering this morning is quantum profit management. This is a new philosophy and involves new techniques for being able to drive profits even when the economy is not growing and where things are very, very difficult. This is a tried and true methodology that a number of forward-leaning companies are using to keep themselves solidly profitable right through 2009 and into 2010, and has really proven to be something that can set companies apart from their competitors in the sense that they can drive a better financial performance even when things are difficult and different from what they used to be. Just a couple of introductions briefly. Bruce Merrifield's a former corporate CEO and owner of distribution business. He cut his teeth early on as a turnaround specialist for distribution companies and has spent the last 3 decades or so speaking, writing, lecturing, and thinking about best practices in distribution management. Bruce sits on the boards of a number of leading companies and spends a good deal of his time flying around the country and around the continent talking on best practices in distribution management. My name is Randy McLean. I'm a former corporate CEO. I am one of the people that always wondered what best practices were and whether or not what I was doing would be called best practices. And I've spent a good deal of my lifetime building and leading companies, and also have spent about a decade working with the Fortune 100 on sales compensation and sales performance issues. So this morning what we want to do is we want to team up and talk to you about some of these best practices and teach you a new perspective that you can apply, that you can bring to your company, and turn on the afterburners under your company to be able to drive some superior performance even when revenues are flat or neutral. We're going to cover a number of things today, and I want to go through the agenda, but I want to let everyone know that the materials that we're using this morning, the PowerPoint deck, and all of the reference materials that we'll be referring to are going to be made available to you after the webinar. Everybody will receive an email package with the links to Bruce Merrifield's site, merrifield.com, when there are hundreds, perhaps thousands of pages of insights into distribution management best practices available for you. Also, quantumprofitmanagement.com, which contains nearly a year worth of Bruce's Quantum Profitgram newsletters and some other materials, plus links and recordings of our webinars on this and related topics. We'll also be sending you information on those websites and on a number of other resources that you'll be able to use to implement some of these things after the fact. So what I want to do is start out by just sort of referring to our agenda. We're going to talk about the unique opportunity we have now because of what's happening around us and why we have an opportunity that really comes once in a generation. We're going to talk about what quantum profit management is all about, and then talk more specifically about how to apply it in the business and what kinds of tools and techniques that you'll use to bring this home so that you can have the kind of market-leading performance others that are using this technique can get or are getting. We're going to talk about cost to serve, which has a lot to do with how your resources are being deployed in service of your customers and how to make sure that they're properly deployed. We're going to talk about profitable service models, which for many people will help crystallize a lot of your instinctive thinking. And then we're going to have a brief discussion about Waypoint Analytics The reason that these webinars exist, the reason they're free, is because my company, Waypoint Analytics, provides one of the key tools for quantum profit management, and we hope that you'll want to use our software to help you with the implementation of QPM at your company. You can do QPM without any tools from us, but certainly we can provide you some fantastic ability to take a look at profitability on a different level that can really aid in applying the principles we're going to talk about today. Okay, so I want to talk a little bit about today's realities to sort of set the stage. There's probably nobody here that needs to be told that the economy has been kind of rugged and that business has been challenging. But what happens is companies can tend to get kind of calcified in their approaches to what they're doing, and it's people that have an ability to sort of think a little bit outside the box and bring some new tactics to bear that are able to get some real performance changes. Frankly, in the economy that we have here, although it's important to keep selling, you can't sell your way to the situation. We have quite a number of clients that are down 20, 30, in some cases 40% in revenues. And it's very, very difficult to be able to grow your way out of it or to even sell your way out of it. The situation is that your existing customer base is probably not buying more and can't buy more because their customers are buying less. And getting new customers leaves you to trying to find some new emerging customers coming out in this market, and those are few and far between, or try and wrest away from the competition customers that aren't already buying from you. And we always have done that, and of course our competitors are trying to do the same thing for us. But the interesting thing is that there is a way to be able to selectively look at the customer base and to be able to focus and target the customers that are the most valuable so that we can deploy our resources on a more fine-tuned basis. And that's part of what quantum profit management is all about. However, companies that think, well, we come in the morning, we're just going to try harder, I don't have a lot of hope for their ability to be able to change the nature of the picture. You really have to start doing not more of what's not working, but you have to add something that will work to what you're already doing. The reason I said that this is a unique opportunity, or we have a once-in-a-generation opportunity, is because at this time in history we have a confluence of events that we only see about once in a generation. And so in the first sense, a great recession can be a great opportunity. And a lot of people are maybe surprised to hear that. But frankly, these kinds of things, these big blows come along once in a while. There are definitely troughs in the business cycle. And at the end of every trough is an upturn, which drives growth and profits, especially for those that have found new disciplines and new techniques that make them viable during the downtime, make them viable and profitable. They will be poised to explode in terms of both revenue and profit growth on the other side. We also have a great opportunity to be able to acquire refugee customers from our weaker competitors that are having a harder time servicing them properly and may not be able to assess their value accurately, which we hope to do. And so we can actually do virtual acquisitions of other people's business, whether they're just downsizing and aren't handling the customers well anymore, or if they're actually folding and leaving customers scrambling to find a new vendor. We have an opportunity to be able to identify those and go pick them up. And then, of course, the recovery brings high margins, high growth, and so that can really help. The second thing that's happening is that technology is advancing, and we've all been through a number of stages. Back when Granddad founded the business, they did all the accounting on ledger sheets, and commissions were paid on a percentage of revenue because that's basically all they had. When when Dad took over the business from Granddad, he brought in, at that time, the computing horsepower was getting to the point, or computing prices were coming down to the point where you didn't have to be NASA or the government to be able to afford computers, and Dad implemented computerized accounting in the business back in the 70s, 80s, and we had our first insight and got a chance to be exposed to gross profit, and that was much better because we had some insight as to where we were making more or less gross profit in the business, and everybody migrated towards paying their sales reps on gross profit, bringing at least the cost of the product into the equation, and that was a good thing as well. Now that we have the business in our hands, computing horsepower has dropped to the point where we can not only afford computers, but we can afford, or we can avail ourselves of super high performance computers, things beyond the scale what NASA and the government had back when. And we can actually take a look at granular net profit in the business, and we can start measuring and managing the business on net profit and account for every bit of the business expense, and look at customers on a net profit basis, products on a net profit basis, vendors on a net profit basis. And we have there's a paradigm shift going on right now where businesses are able to see this information and be able to take a look at two customers but buy the same thing in the same quantities at the same price, but have vastly different product pictures or profit pictures because of the cost to serve varies between the two customers to such an extent that one of them is quite profitable and the other one is actually a huge profit leak in the company. And most people can't identify the difference between them, but now we can. So that brings us to the beginnings of quantum profit management, and what we want to do is get people to start thinking about running the business a new way, looking at the business a new way. Now, the quantum and quantum profit management is the same quantum as from quantum physics, and what it really means is the smallest indivisible unit of matter in physics. And what we're recommending that people start to do in their businesses is start to break it down into small segments and look at the absolute bottom line profitability in each segment. So whether you're servicing one industry or another, or where you're looking at a particular rep territory, whether you're looking at a particular product line or product category, whether you're looking at vendors, it's very important to break the business down to a point where the things within those businesses have some kind of a common operating mode, and start looking at the costing on that operating mode to make sure that it's in line. And one of the real critical issues is that people have, from time immemorial, certainly throughout the length of my career, I was taught, and I later on went on to teach other people, that it costs such and such to be able to run the business, and we need to make sure that we're pricing our product and selling volumes that are sufficient to cover our costs in order to make the business profitable. Quantum profit management allows us to turn that completely around because what is really happening out in the market space is that you have a pool of achievable gross profit. Achievable or provable gross profit. You can look at your customer base or any segment of your customer base, and you can say, I can for sure prove that there are these number of customers out there that are willing to pay these prices for this product, and they will generate a certain amount of gross profit in doing that. And what we're recommending that you begin to do and get your organization to do is start thinking, that's my gross profit budget. And what we have to do is we have to find a service model so that we can deliver the goods and services to that customer within that cost envelope, so that our costs cannot exceed the available, achievable, and provable gross profit in any one of these segments. And so when we start to turn that around and start to look at it in a different way, we can start to tailor the business, tailor the infrastructure, tailor the way that we serve the customers in such a way that we can guarantee that we're going to be profitable on every customer, on every product line, on every vendor, in every market. We can look at how we're servicing the customer, and we can fit our service model to the achievable gross profit. And that is one of the first great changes that you can make in the business today that will make your financials better at the end of this month. So, Bruce, can you maybe take us on and talk a little bit more about the stages of QPM?
Sure. I think, first of all, just to step back and reflect on some of the things Randy has just said, if you look at the technologies that we're using today, I don't think 2 years ago that the average distributor knew how to get on a webinar. They couldn't get the GoToMeeting software through their spam filter, et cetera. The cost of Internet transmission and reliability is collapsing, and the cost of remote storage, think Facebook and all those pictures that kids have out there, it's become nothingness. Database software has continued to just, become phenomenal over the last 10 years. So with an Internet connection, companies now can radically outsource things they used to do, but they can also radically new source. In other words, you can type in a total software service capability you couldn't have before. So if you take all that Randy is and knows as far as his serial entrepreneurial software activity and his financial management of his companies, et cetera, take all that I know from 30 years, 35 years of turning around distribution companies and working 150 different channels and say, well, all right, how would you create a parallel reporting system? You have to have financial reporting to pay your taxes on time, but otherwise, financial numbers average all the stuff. So you can't find extreme winners and losers and then figure out what to do with those. But with quantum profit management, you can zero in on the extremes. You have a ranking report at the very top. You have a ridiculously profitable customer. At the bottom, you have a ridiculously, shockingly, frankly, losing customer. You say, well, I don't want to lose the most profitable guy. I bet if our whole team went out there and just kind of said, hey, can we kind of walk through and look for ways to tweak and help and take it to the next level, you'll find ways to do it, and you'll also find more business you didn't know you had. Earlier, Randy said, you can't sell your way out of this. Yes, if you're a financial reporting management-driven company, if you're a feet-on-the-street-driven company, the mentality is sniff and scurry like those two little mice and who moved my cheese. It's like, oh, my God, business stinks. Quick, go call on new customers. Well, what happens is if you go shoot prices in today's environment, and the customer says, well, let me think about it, which is code for I'm going to show it to the entrenched incumbent guy. If he passes, it's because he knows the cost of serving this account exceeds the margin dollars that are left at this price. You have just won new sales and new margin dollars, but at a higher cost than the margin dollars. You're going to have bigger losses, and you have to finance incremental inventory receivables. You could go call on smaller accounts that are further away, but this isn't law of diminishing returns as far as profitability. It's law of increasing losses because typically your full service model costs exceed the margin dollars in smaller transactions that have to be delivered further away. But we're assuming that we already own all of our core business. And of course, if you look at your sales force and say, I don't think they're all equally competent. I don't think they all, go out there and get all the business they can and so forth. I wonder if there's more upside potential in our, quote, best accounts. So the first thing that anybody should do when they say, gosh, I'm not happy with my current profitability, they have to specifically define their core business. So that's typically, 10, 20% of your customers are making 150% of your profits to cross-subsidize the losing customers. But you can also do item profitability ranking and realize, 5 to 10% of my items are making 120, 30, 40, 50% of my profits to cross-subsidize the losing items. You start to realize that your most profitable customers are buying your most profitable items, and those two are like chicken and egg. They're mutually interdependent. One makes the other possible, and it sort of became a snowball over the years that was quietly growing within your business. So what we want to do is pierce through the financial averaged out numbers, find out who those extreme profitable customers are, find out the extreme profitable items, and make sure we maximize selling all of our most profitable items to all of our most profitable customers, and we tune our fill rate economics for both us and our customers going after that. And I'm not going to get into great detail today, but we got all the plays, we got videos, I got lengthy articles on this stuff, but the key is you have to have the numbers to find out where to start to work. And what you find is I sort of come up here with the 21% of your customers will generate 250 or more of your current profit. Because what you find out simply, 20% of the customers might generate 150% of the profits. But if we could understand the core business and define our service value metrics a little bit better for those best customers, we'll get 10, 20, 30% more business out of them. What we don't see right now is the bottom 1% of our customers destroy about 20% of our true internal peak profits. But that's because there's zillions of transactions for not enough volume of stuff. But if we have a lot of activity costs and paperwork that goes with it, so does our customer. So about 80% of the time, these super losing accounts are actually lose-lose activity fests that we're having with each other. And if we go out and sort of analyze what's going on with a few tweaks, we can figure out how to make our buy-sell process more effective for both of us. And in fact, instead of losing money, you start to win money. And the customer's so delighted, they say, by the way, here's another 10, 20% business to be had. And then generally, if we can tweak our fill rates higher on our core items and systematically sell those to the top 20%, we'll keep them, retain them, and penetrate them better. And you start to add all of these increments up, and you get huge increase in profit. So it's for a few hours at the branch manager's level, focusing on what I call high profit impact accounts, you can get huge upside return. And that's the sort of management leverage we want to do. Second point out of Renew the Core there is when we look at all of our profitability, we'll find a subset of customers that, frankly, are just small customers and chronically so. They haven't grown anywhere in the last 5, 10 years. They're self-employed, just doing what they do, working. They bought themselves a job. They're not working on a business model and trying to create a big business that's got value and exits and all that sort of stuff. They're just doing what they're doing, working twice as hard to make half as much as they had a real job. And all they can give you is small orders and small annual volume. But when you look at the traditional model of inside sales and warehouse guys picking stuff and putting it on a truck and delivering it and having a lot of paperwork to sort of make trade credit go and then assigning a sales rep, whether they call them or not, the structural cost of our service model exceeds the margin dollars in transactions. And these are really what I would call not full wholesale service customers, but wholesale customers. They need to go to kind of a cash and carry Fastenal, W.W. Grainger kind of place. It's a hybrid. It isn't, retail mall space, but it isn't deep doo-doo, district warehouse space. And when we look at that and realize how much margin dollars, $400 per month minimum, that an account has to have to support outside sales coverage today, write down Article 4.11, do the math on there, a lot of distributors realize, oh my gosh, I have actually too many salespeople. And to sort of say, go out and call in more BC customers when only A's will support outside sales, and all the A's are already being called on by good or bad guys, just depending on who inherited them last. We may actually have too much outside sales force badly allocated to customers that can't afford it. It's like having personal waiters running around giving free drinks to people in casinos playing the quarter slot machines. The casino's going to lose money in that model. They don't make enough money on those small little customers to support that kind of extravagant service package, if you will. Then once we zero in on the core, we can do a better job of defining what is basic service brilliance for this core, fill rates being key, sort of the keystone foundational thing, but 0 errors, on-time delivery, et cetera, and start measuring those, but we won't get them improved unless all the people, frontline service employees, their hearts, minds, and wallets are sort of wired into making these numbers happen so that we can keep and grow and maintain these super profitable customers because they know what's in it for them. And this whole idea of measuring service excellence numbers and people engagement numbers to get better profits, a lot of people say, how do I do that? Waypoint can do it. Just trust us on that.
Right. Now, and I should tell you that we have another webinar where we cover a lot of the tactics on this in specific detail. It's called the RPIs webinar. I think it's running again in a week or 2 weeks' time. You'll all get notification on that. And we'll give you, in that webinar, a lot more information on some of these tactics that Bruce has been mentioning in order that really get down in the weeds and talk about what those things are.
And and the last thing is that on the adapt and proactive for the environment, it turns out at a branch level, if a branch manager knew and super focused, got the whole team super focused on the 5 most profitable customers, the 5 biggest losers, to turn lead accounts into gold, in other words, transform them to winners, and the 5 biggest upside growth, in other words, over the next 5 years, which customers are going to grow the most. So if you married them, they'd grow you and your profits. Let's call those gazelles or target accounts. Then you can afford to literally do one-off service flexibility kind of stuff for 15 accounts. I mean, you may have 300, 400, 500 active accounts, but let's face it, if we can hyper-focus on the super leveraged ones, then we can stay much more in tune with where they're growing to, what their objectives are as far as supply chain, procurement, and uptime productivity that they want because they're buying from the right supplier who can take care of their needs. Next slide.
All right. So that brings us to the principles, the 8 principles of QPM. And what we'll do is I'll just touch on them here, and then we'll get into them in depth throughout the rest of the webinar. So the first principle is that you're making more money than you know, and every company has a core profitability, which in a lot of cases can be enormous. And what's really going on is that you have a lot of cross-subsidies going on. You have too many money-losing accounts that are siphoning up the internal profits. And the first thing you want to do is be able to get in control of that. And that's where the tools like Waypoint come in, because Waypoint gives you the actual true profitability numbers for every nook and cranny of the business, so you can tell who those guys are, and that helps you focus your efforts on them. Second thing is to measure and evaluate the quantum level. That means break it down. Don't take these broad financial averages and work from them, because they're not accurate enough for good management. Third thing is manage on net profit. Net profit's the only thing that really matters. It's the thing that that pays our bonuses, pays our supports our company, fuels our growth, keeps us in line with the bank, allows us to borrow. The net profit is absolutely crucial. And there are no good surrogates for net profit. If you're managing gross profit, you're likely doing highly dysfunctional things, and switching to net profit management will clear that up. Make sure that you manage on the deltas. This is absolutely crucial, because what sets your company apart potentially from other companies is knowing which product lines, services, vendors, reps, territories, SKUs are actually helping grow your profits, and which ones are taking them in the other direction. That can help you focus like a laser on the things that matter, and can turn the business picture around in short order if you're struggling, or the company's not doing as well as it used to. And it is the one management technique that will really separate you from your competitors. Financial averages mask what's really going on, so avoid using financial averages and dig in, and we'll show you some of that. Understand and manage your service models to make sure that your cost to serve, your service model, fits within the available gross profit budget. That's absolutely crucial. Identify and stop non-strategic cross-subsidies, and we'll talk about some cross-subsidies that you'll probably be planning, and differentiate those from cross-subsidies that are going on that you don't even know about and are harming your financial performance. And then synchronize goals and incentives to make sure that everybody, the whole team is on board and working towards the same ends, and we'll show you how that's done as well. Okay, so first thing that I want to make sure that we have in our vernacular is cost to serve. Cost to serve is essentially everything on your P&L that falls between the gross profit line and the bottom line. It's really all of the expenses in your business, and in reality what it is the amount of money that you spend to deliver your goods and services to your customer base. And so recognizing cost of service, something more than just an accounting entry, but something that can truly be managed in a granular and intelligent way, is the first step to getting in control of the cost of the business, and making sure that the resources are being properly deployed where the customers can afford to pay for them, and they're not being wasted on areas of your business where there isn't enough gross profit budget to fund them. So you really need to be able to make sure that you understand and recognize and can measure your cost to serve. And then when you do that, you've got to infuse your business with CTS thinking, get everybody on board, make sure everybody understands what cost of service is all about, and right down to the lowest level, make people aware that these are resources that are limited and finite and need to be deployed and used where it makes the most sense and not just given away or used on all sizes and all types of accounts, but are mostly deployed where the accounts can afford them and where the profit is going to be generated. Okay, so so the first tool that we can begin to use is the customer profitability ranking. This is one of the most crucial tools that you would want to use. And Bruce, I can pull one of those up for you if you'd like to give us a few words on that.
Yeah, and I think as a backdrop, I will say that I've been talking about customer profitability and plays that come out of that since I taught a Harvard Business School case study. It was written on my paper distribution company back in 1978. And everybody just shook their head and said, well, where do I get the data? And when you think about the cost modeling that Randy's company can provide, to be able to catch the incremental profit or loss on a given line item pick with many scenarios. I mean, that could be a brokered ship direct. It could come indirect. It comes from a master distribution center. The front end, the customer could have entered it a web order entry, so it's less cost than if it came to an inside sales. There are lots of different sort of service activity step scenarios that could go into any given line item. But Randy's done it all times many distributors and many channels. And so you could try to do this yourself, which is a daunting task. You'd say, wait a minute, here's this huge sunk cost capability that he's created. So, he sucks your data out and tweaks it and puts it, and boom, you get these reports. And right away, people want to argue about, the extremes and say it can't be that profitable, can't be that big a loss. But here's the key point, which is that Randy's done, his staff, they've done all the heavy lifting. You and your team get to sort of be the tweakers and the editors. And some people say, well, I'm not doing anything until I know this is perfect. It'll never be perfect, and your financial reporting system is massively imperfect. But the key is to turn it on and both, sort of saying very quickly, we realize that this company at the top, this is a real distribution business, incidentally, that Randy has with all disguised names. But at the top is Statoil Marketing and Trading. And here's a company that did $819,000 in sales. The GP was, whatever blocking there, was $283,000. Then he subtracts cost to serve, and the net profit on one account was $93,000. Well, you can tweak the model a little, and you can make the 93 become 97, or you can make it become 85. But anyway you look at it, it's ridiculously profitable. And so we don't want to lose them. So maybe we ought to create more understanding of the account and get more people out there to see what's going on and do little micro-innovation, tweaking things to take them to the next level. Same at the other extreme of the report. So you look at the top and you see how few super winners you have, and then there's just this big thing in the middle and the super losers. You were going to say something, Randy?
Yeah, I'm sorry. I was just going to point out that we can see where that cost to serve comes in, but I'll show that in a moment. So I'm sorry. Go ahead.
And now we're looking at the bottom of this all the active accounts of this particular company, and you see at the bottom, a guy like Charles Ritter who did $144,000 in sales. That's good sales. And they did $61,000 in margin dollars, which is good margin dollars. But when you look at the cost to serve, it's $89,000, which creates a loss of $27,848. Now, incidentally, on margins of $61,000, some sales reps getting paid a fair amount of money. And when you say, gosh, we're losing money, we need to go out and work with these guys, the salesperson has got a conflict of interest. We have paid these salespeople to go get margin dollars, and they do. But they don't really worry about the cost to serve. In fact, you start to realize, our sales guys are all for lots of just-in-case inventory that never gets bought by the customer who's supposed to buy it. They're for loose credit. They're for extra trucks. They're for hotshot this, that. Well, they don't want to charge fees for any services because all these things militate against getting margin dollars. We'll come back to that. But the point is that we can fool around with the allocations and we can make that number shift a little bit, plus or minus 5%. It's still a huge loser, and there's a lot of activity costs for the customer. How do we turn lead to gold? So by looking at the extremes, diving very deep as a team and a brain trust, because you get virtual Bruce and Randy with the service, you can start to come up with lots of ways of making the better even better and finding another one like them and turning the worst into winners. So that's
right.
a first initial report you look at. Now, incidentally, go ahead, Randy.
And the thing I wanted to sort of remind people of is that when we talk about this available or achievable gross profit, this customer has a $61,000 gross profit budget, and in Waypoint we can see, how much we spent servicing this customer by breaking down, how much fleet expense they consumed, how much sales expense they consumed, and we have some very granular numbers, and we can see that the reason the customer is upside down is, frankly, we've just put too much resource into this customer. Now, if we can get this customer to buy on a basis that consumes less of our company resources, we can put the customer into the black. And by doing that and having the salespeople work to do that and motivated to do that and working with the customer, there's benefits all around where both our company and the customer's company actually wind up ahead of the game by reducing the resource consumption. And the reason why is because there's a mirror for everything that you have on your side as an expense. Your customer has a mirror image of that expense. For every time you have to process an invoice, people paid to do that, they're paying somebody to write the order that generated the invoice. Every time that you make a shipment, and as many shipments as you make, they have to have somebody out in the warehouse and on the docks to receive that in. They've got to write a receiver and have paperwork to go with it. For every time that you send out an invoice, that somebody on the other end has to enter it in and has to get it paid. And then you have to spend money to, having to close up the sale or the receivable. And so by integrating more tightly with your customers, there's a way to do the same business with the same margins, the same pricing, but for both sides to consume less resources. And both companies, both you and your customer, can be more profitable by reducing the amount of resources that are consumed in the interaction between the companies. So for the largest customers that are making money or are losing money in your business, you can get more tightly integrated and cut some of those costs out for both of you. And it's a win-win situation.
Yeah, and I would say that Waypoint is sort of it's a journey process. You get the elemental quantum profit stuff, then you sum it up and you get ranking reports like customers and items and suppliers and sales territories and so forth. Then you look at the extremes, and that raises new questions. And then you'd say, gee, wouldn't it be great if? And the answer is, well, we already have that. So if you wanted to, for example, right-click on one of these big losing accounts, you can get a list of all the transactions for any period of time, let's say a year, ranked from the most profitable transaction to the least profitable transaction. You can also see the items. So you go, oh, they bought 38 items from us in total last year. And you go down and just look at the items that you lose the most money on and think, oh my gosh, like every day they call up and wanted 2 more paper clips. Why aren't we just giving them a box of paper clips every 6 months? I mean, we'll even pay for the inventory to be over there to save 4,000 line item picks and to have save emergency orders for a paper clip because somebody over there has a blind spot about thinking about just-in-time inventory for, frankly, MRO miscellaneous small ticket items. So what happens is when management can right-click and look at the detail, right away patterns emerge. You go, oh, you know what's going on here? Well, hey, what if we... So you have ideas before you even go out to do a little bit of an audit and a visit to explore and co-create what you might possibly do together.
Absolutely. And what I want to remind people what they're looking at here. This is not just a list of the SKUs that they bought and how much gross profit was in them. Every one of these is fully costed out. So when we see a net profit here for a particular SKU, that reflects the sales expense on that SKU, if there was any, the warehousing expense on that SKU, if there was any. There could have been a direct ship, in which case there was no expense. The order entry expense, if there was any. The amount of fleet expense or delivery expense that there may have been when this particular customer bought that particular SKU in the way that they buy it. Maybe they bought it along with a lot of other things, and then the expense of the shipping and the expense of the invoice is very, very small because it's shared amongst all the other items on the invoice. Or maybe it's a customer that only bought this one thing the one time, and there was a truck that went out with a box that's 3 inches cubed, and there was a $125 all-in cost to serve on that order, and there was only $13 of gross profit on the whole deal. So that's all reflected in the reports that we're looking at. So we can say that when this particular customer is buying this particular SKU in the way that they bought it, this is the profitability of that SKU and the bottom line profitability. So we can take a look at their entire purchase history, their order history, and we can get some insight into what it is they're buying and why it is that we're making or losing money on it. And that gives us the exact information we need to be able to go and transform the business into something that's profitable. Sorry,
maybe to get out of the weeds, well, why don't we just jump ahead to the whale curve? And,
yeah, that's a great idea. Okay, yeah.
Picture's worth 1,000 words.
Sure. One of the things that you can do, of course, the first insight is that when you have the customer profitability ranking, you can choose customers or you can evaluate customers based on what they're really worth to you, because you can tell how much bottom line net profit that they're generating. And one of the things that is very important as a principle is that working the ends of the list is where you get the biggest bang for the buck. The guy at the top that's making you $93,000 a bottom line net profit in a year is very, very important. He's somebody you want to service to death, and you treat him differently than the guy in the middle that's doing, $1,400 a business and making you $3,000. And even if he doubles it, he's not going to make a big difference to your business. And what Bruce is talking about is there's a technique that you can use to graph the whale curve. And what we're talking about is graphing that net profit column. So we start with 0. We put our first big customer on $93,000 from Statoil. Then we take our second biggest customer, third, fourth, fifth, and so on, accumulating all the profit on here so we can see how much money that we're making on these customers. Pretty soon we run out of customers that make us money and get into the break-even accounts, and then we start into customers that lose progressively more and more money until at the tail end of the whale we have the biggest money-losing customer. And he's a big one because he takes us right down to about $200,000 back in 2009. And what's interesting is that this company has $233,000 in net profit, but internally it peaked out at nearly $1 million. So in the first 250 customers, we had almost $1 million on the bottom line. And then through the rest of the customers, the resources that we put into the break-even and money-losing customers down here, all that money was lost back in money-losing accounts at the bottom of the list. And in this particular company, there's just under 800 active customers in 2009. And if we could do something about the last 45 of them, our bottom line, if we could just bring them to break-even, our bottom line, without selling one extra dime to one extra customer, would have gone from $233,000 to $800,000. We would have had more than 3 times the bottom line profit. And if we could just get hyper-focused on solving the profit-loss problems in the last 45 customers, and every business has a whale curve. The only difference between businesses is whether the tail end of the whale stops above or below 0. And so in your business, you have a whale curve. In your business, you have an enormous amount of profits, and so we talk about you're making more money than you know. And if you can get in control of the customers at the tail end, and at the same time protect the customers at the head end, you can absolutely have a magnificent increase in bottom line profitability in very short order. Sorry, go ahead, Bruce.
Yeah, and when you look at a curve like this, what you're not seeing is the dynamic upside of the different plays that you can apply. So, for example, if you said, oh, my gosh, look at the head of the whale. We've got 10 customers that are the whole franchise. Let's go out there and understand them more deeply and thoroughly. And make a note, go to my website, merrifield.com, download Exhibit 59. It's a 24-page sort of training guide on how to go out and do a simple little audit looking for micro-innovation tweaks. You do that with these best customers, and you find out that actually there's a lot more upside. You know, salesman says to buyer, am I getting all the business? Oh, yeah, you're getting all the business. That's the way to handle pesky sales reps. So they just assume they're getting all the business. No, they're getting a third of the business, it turns out. So you go out as a team, and boom, you get 50% more business, and it gets even more profitable, because once you're making money on an order for a fixed cost to stop at a truck and fool around paperwork, you get more margin dollars. The incremental flow through of the margin dollars really is a lot higher. Then if you look at the flat part of the back, and even particularly the long sloping part of the whale curve, most of those are chronically small, growing, nowhere customers that we're providing old-fashioned service model that costs more than their margin dollars a transaction. We're giving free drinks to quarter slot machine people. If you say to these people, look, you know, sorry to spiraling costs, you know, send them a letter, here's our new minimum order, and freight's unbundled, some will start to leave and some do, but on average, you know, half the people order half as often, twice as much, and or they'll buy more items they didn't know you had before, and they become profitable. The ones that leave and go paralyze our competition's there. I think they should be super busy losing money on lots of little customers growing nowhere kind of thing, and take their eye off their key accounts, which become our target accounts. And then, of course, you go to the tail of the whale, and I mean, I'll give you one example where customers lose $150,000 a year. We hopped in there with our hip boots, you know, worked around whenever push comes to shove. It became a swing from a loss of $150,000 to a profit of $100,000. It's a $250,000 swing per year, and we got a 5-year contract. It was a $1.2 million bottom line swing for 2 small branches and part of a chain. So those kinds of, I mean, this company right now is making $1 million too. The truth of the matter is, once you get finished with the dynamic upside, the company's making $2 million, free and clear, and there are no losses. Well, you know, the losses have been massively minimized. So that's the kind of power and upside once you can focus in the right places and you have the new plays and new insights to go along with them. Next slide.
Okay, so essentially that brings us to the next principle: make money on everything you do. And what we want to do is make sure that you start to segment the business, start analyzing the net profit or PBIT on profit before interest and taxes, and make sure that the cost to serve, the service model fits it. So, and having some insight into where the profits are and the losses are helps you understand where you have dysfunctional service models so that you can attack them. All right, now this brings us to the next principle. Bruce was talking, or I had early on mentioned about about managing on gross profit. And I got to tell you, all the hair stands up on the back of my neck, because for several decades in my career, gross profit was all I had, and that's what we did everything on. Now, this is good gross profit. That's a great account. This is bad gross profit. This is a bad account. You know, the margins just, you know, they're high or low, and that was the best tool that we've had. But let me show you an example from a real business of what's going on. Again, the names have been changed to protect the innocent, but but here's what we had. We had a number of different sectors in this business, and for my entire career, I would have looked at auto parts at 18.1 margin, say that's a low margin part of the business, not very big anyway, and that's not a place I want to emphasize. The food sector is our best sector because we make our best margins there, and that's where we really want to go, and it's big volume, and this is, you know, when we're servicing the food industry, this is the place where we want to grow the business. And in my past, I would have put together a huge program for this, and gone to town with that philosophy and communicated out through the field. But look what happens when we start to look at the actual cost to serve and the net profit. Once we have the information, and remember, this is real numbers. What's happening here actually is that even though the gross margin is higher, we're actually underwater in the food business because our service model doesn't fit it as well as it should, and the additional gross margin is being wasted. And meanwhile, lo and behold, and this was a total surprise to me and to the owners of this company, they're actually making money in the auto parts business. And so this is just a great indicator of what happens when you're managing on gross margin, and it's disconnected from the bottom line. And at the beginning, nobody believed this. but we see this every day now that we have all these numbers. This happens all the time. And frankly, you can tell if you have the problem, if you have sales reps that are bringing in what looks like good business, and you have to go out and fix the business in some way because you're losing money on it. You know you have this problem if you put together big programs like I would have here, where I said, okay, we're going to de-emphasize the auto parts and really go for the gusto in the food sector, and I would have got the increased sales in the food sector, and the company wouldn't have made any more money or might have been worse off. And so my big, you know, if you're rolling out big plans and they're doing at the top line what they're supposed to do, but they're not affecting the bottom line, then you've got this problem. And I've seen it over and over through my career. I'm sure a few of you have as well. And so if you've ever wondered why those plans don't work, this is the reason. So it's absolutely crucial to be able to get that bottom line information so that you can manage on that. So, the takeaway from this is we really want to start managing on net profit because it's the only thing that matters, and it's the thing that really drives the most important parts of what goes on in the business. So, so we want to go to town on that. Now, let's have a deeper look into what we were looking at a moment ago. We just saw the food business. Now, what Bruce had mentioned a while ago is that financial averages will mask what's going on. And this is what happens when we take that food sector, which we just saw with an $83,000 loss, and we break it down into finer detail. Inside that $83,000 loss, we have a $233,000 loss lurking and a $200,000 net profit gain. So in the fast food business, we're way underwater. Things are a lot worse than we knew. But there's also a diamond down there in the restaurant trade, and we're making good, solid profits in the restaurant trade. So the ability to dig deeper than the financial averages helps us understand where to go and attack, the service models in order to make this thing fly. And if we had just ditched the food business, we would have thrown the baby out with the bathwater, and there's a $200,000 baby here, and we wouldn't have been able to protect it because we wouldn't have been able to find it. So it's absolutely essential that we get away from the financial averages from the financial accounting and get something, some information that shows us where our profits truly are so that we can hyper-focus our efforts. Okay, so that brings us back to what I'd mentioned a little while ago on the customer profitability ranking, talking about managing streams. Now, Ruth, why don't you take us through this?
Yeah, what you find is that if you only have one bottom line, and if we do these different profitability ranking reports, this one guy said, "Wait a minute, Bruce," he said, the peak internal profits for 22% of my customers is 152%. The peak internal profits for 33% of my suppliers is 172%. He had these different whale curves for these different things. I said, well, yeah, well, they all overlap. And what you'll find is if you went to your biggest losing sales territory, you're going to find your biggest losing customers. If you drill down your biggest losing customers, you're going to find out they're buying the biggest losing items you're selling. And of course, that territory even weighs down that branch or whatever. So we're sort of double counting or looking at the same thing in different ways. That's, again, where it gets back to this sort of this phenomenal dance, this chicken and egg. You have a critical mass of common customers who are heavy buyers of your most profitable items, and it's their collective demand, their critical mass of sales. It's helping you buy that stuff well, pull it through your warehouse, reorder it frequently to fine-tune fill rates very high, and not have excess stock and stock outs because you can tune your inventory very rapidly all the time. But on the flip side, it's those core customers that say, yeah, but I want more complementary items. But since they all buy the same stuff, you drag it in for one guy, and 2 or 3 or more people are doing it. So what we want to do is zero in on this intersection of most profitable items and most profitable customers, and figure out how to optimize that and then maximize that, because that's where our huge excess profit and free cash flow. Because when you make profit here, after a while, it's such a mature, you own it. kind of business at a geographic level, it's cash to do stuff with. You can't do it right now because sadly it's being devoured by the losers, and we have to say we don't have to accept that. The super losers, we can work with our suppliers and we work with our customers to figure out little workarounds to turn substantial losses into minimal losses or even gains.
Yeah. And Bruce, what we're looking at here is we saw a moment ago the customer profitability ranking, but we also have a vendor profitability ranking. We have a SKU profitability ranking. And so we can go and find these kinds of things in Waypoint to be able to find those intersections and be able to understand why they are what they are. And in addition, we can pull profitability numbers for our profit breakdowns on any of the SKUs so that we can see why a SKU is unprofitable because it tends to be sold in a different way or tends to consume certain resources when the customers are buying it. And so we can gain some real insight that actually we can turn into action in terms of planning and understanding the dynamics of the business at a granular level. Sorry, go ahead, Bruce.
And and to be able to sort of say, okay, let's take a super losing item, and the items that are super losers actually are very popular. You pick them all the time. The problem is you're picking, pennies worth of stuff. And then maybe it's 50 cents a widget, and you've got 40 cents of margin in it. So you're like, oh, we got an 80% margin of this item. Isn't that great business? Yeah, it costs you $10 every time you pick it. That needs to be sold in a very different way. You don't sell paper clips one at a time with people involved in paperwork. People just buy a lot of paper. I don't know how many paper clips I got in my drawer here, but a lot. I mean, it could last me a couple of years. I don't know. So once we can zero in even on the customers, we could say, oh, what kind of, here are the heavy users that are buying these things, a small item. They're killing themselves with transactional activity costs. What's a win-win way of selling this in a different way? And you work here to help. In other words, when people look at new reports, they're not sure what they're seeing, so we help you interpret it. Then you need new sort of tactical plays, and you need sort of new skills to go along with it. Then you need new tracking reports, and ultimately you need new incentive, plans to get really moving along in the same thing. It's all in Waypoint. It's like a multi-layered cake that allows you to do that. So, again, huge leverage at the extremes.
All right, so now that brings us to one of the techniques. We recommend that you manage on the 5x5, and what this essentially is this is a dashboard type report out of Waypoint. You can replicate this probably with your own information if you don't have Waypoint, or of course it's instant if you do have Waypoint. But what it's all about is we talked a while ago about using those profitability ranking reports to help us identify and to focus on the places where we're going to get the biggest return on our time investment. And what the 5x5 principle is, Bruce has been recommending this for 30-plus years, is it brings all this stuff together in one place so that a rep or a branch manager or even a sales VP can focus at whatever his level of interest is on the ends of all of these reports, and understand or make sure that there's a certain percentage of their time that's dedicated to managing the things that really are having the biggest impact in his performance. So Bruce, why don't you tell us a little bit more about the 5x5 and walk us through what's in here?
Yeah, I think when you look at a whale curve and realize you want to focus on extreme leverage, but salespeople are very gregarious people, and they tend to be, very, 5 miles wide and an inch deep, as extroverts are, and they're caught up in the activity of all their customers. And frankly, historically, the more customers they had assigned to their number, whether they call them or not, in theory, if any margin dollar came in, or they were going to get some sort of, compensation for it. And they may not call on some of these people, but small, lonely, growing nowhere customers will find the sales rep, they'll call them and bug them, and it's like barnacles on your hull and holes in your sail. Your boat just can't get any momentum because you're being, your energy is being dissipated. So, and I would like to be able to go to a sales rep and say, look, these are the critical, most profitable customers you have. What do you know about them that no other sales rep calling on them knows, and what are you doing that no other sales rep is doing to take this relationship to the next level? Ditto for your biggest losing accounts, and maybe we have to come with a different incentive plan so that you have incentives to try to want to figure out how to turn losses into profits, because right now they may be getting paid for the margin dollars in those accounts, and the same on the Super Gazelle target growth accounts. But we can't know more, do more, and be more to a customer unless we hyper-focus, but we have to know which ones to do. The other two boxes are the most up and most down accounts, and what happens is you have 1,000 active accounts, or a universe of 10,000 if you're a chain or something, and it's like flipping 5, 6, 7 nickels, and they all come up heads. Gee whiz, 10 heads, that's 1 in 1,000. Who would have thought that this huge opportunity, this huge disaster just fell in our lap? Well, what I want is an early warning report to say, hey, why is this guy month over month gone up so much, or why has this guy just stopped buying and gone down so much? What's the story? Quick, let's jump on it and make sure we manage it, rather than waiting a year and a half saying, gee, didn't we used to do a lot of business with those guys last year? Or oh my gosh, why did this guy take off and then fizzle? Well, we didn't know why it took off, and we forgot to be there to capitalize on it. So you can tune this for a sales rep. You can then summarize it and all-star it for a branch, and you can even do it for a corporate. So in theory, you have 25 accounts for a 10-location chain, where the vice president of strategic accounts is hyper-focused on trying to take these kinds of customers to the next level.
All right. So what we want to do is we want to start thinking about cost to serve, making sure that we have service models that fit, whether it's the customer or the product. We want to make sure that we're doing whatever we can within the gross profit budget that we have. And so we've got to start to measure and monitor cost to serve. We have to have a way of finding out what the cost to serve is in any segment or any customer, so that we can start to assess whether the customer is consuming too much of our resources, or whether it's just right. And so getting that information and getting that information in the hands of people that are going to be making decisions on what they will or won't do on this situation is very, very important. So I think that everybody here probably understands how they would communicate that inside the company, but the fact that to start communicating and start putting the tools in their hands is really the important thing. Okay, now Bruce has pointed out before that there's a parallel of cost to serve over on the customer side, and that's their total procurement cost, or TPC. So, Bruce, did you want to say a word or two on this?
Yeah, I think that humans don't like to change, and when you go to a sales force and say, historically, we've got you focused on margin dollars, go get it wherever you can find it, whether we make any money or not, it's not an issue. Now we're saying that's an issue. So we want you to be very highly tuned to cost to serve. So proactively, when you're going out to hustle business, now you'll start to ask questions to understand, and you can, with Waypoint, you can even simulate, see how much money you would make or wouldn't make given certain conditions and so forth. But on the flip side of the coin, as we saw with super losing accounts, where we have lots of activity costs, so does the customer. So the customer turns out that they have a much higher total procurement cost than they really could or should. So now the sales rep is going, oh, I'm becoming a little bit of a business process consultant here. And ideally, by working together, the TPC goes down, and so does our cost to serve. So it's a win-win. And this basically puts a sales rep at the next level. Right now, too many reps are out there saying, hi, 90% of your spend is on commodity items you can get from any other distributor up and down the street, same brand or equally excellent Asian clones for even less. How about if I shoot you some prices? And that's just not very productive, and we don't perceive that that's very valuable. As it got checked, I asked distributors, rules for distributors, how many of the manufacturer's reps that currently call on you are worth seeing? And the answer is 10% are worth seeing. 90%, frankly, are a waste of time. And they cost $500 a call when they show up at a distribution location, as opposed to $100 a call when a distributor sales rep shows up at a customer. So, this is a supply chain trend. The National Association of Purchase Managers renamed themselves the Institute of Supply Management, 2001. They're no vice president of purchasing anymore. They're vice president of supply chain. And that's what they're thinking about, is how do we get a TPC system? We want to consolidate, integrate with fewer, better suppliers. Well, we want to be those suppliers, and we have to talk that language, and we have to be aligned compensation-wise with it. So, if we're just patient and repetitious, and education is the mother of repetition, the mother of learning, we'll get there. And that gets back to Randy's point about inculcating over time the whole idea of thinking about CTS and TPC as opposed to margin dollars and margin percent, because historically that's really all we had to go on. Now, historically at bows and arrows we could talk about better arrow tips and so forth, but hey, these are automatic weapons with night goggles. It's going to wipe out the other guys out. So let's just get over it and get used to it, and use these new, more powerful tools, these new, more powerful insights, this new, more powerful proactive and remedial selling that we can do with these tools.
Right.
Next slide.
Okay, so now let's talk about cross-subsidies for a moment, because one of the things that goes on, and in the example we saw before, we had the restaurant trade where we had $199,000 of net profit being generated in the restaurant sector, and that was all of that money was being siphoned off into losses to support the fast food sector. These are the kinds of cross-subsidies that go on that are non-strategic. We didn't choose that. It just happens that that's the way it is. And effectively, the restaurant trade is giving us lots of profits. It's piling up in the warehouse, and we're paying our people to shovel it onto trucks and carry it out to the fast food guys. And because the losses are even greater, we have to go to the bank hat in hand and borrow another $33,000 to add to it to keep the party going. We've got to stop this. Now, sometimes we make cross-subsidies. We say we're going to bring in this line, and we've got this big customer, and we're going to sell it as a loss. We do that to customer because it's going to give us volume, the ability to sell. We make an intelligent business decision that says we're going to take a loss somewhere here because it's going to give us more than the loss back somewhere else. And that's a strategic cross-subsidy, and people do that all the time. But what happens in every business is there's an enormous number of non-selected, non-strategic cross-subsidies that are just happening. And what we're trying to do is we're trying to cut it off, and we're trying to divert those profits back into our bottom line by stopping the profit losses that we have going out where they occur. And plugging those profit leaks is the key in 2010, right now, without revenue going up one bit, without customers buying anything more. It is the key to us being able to put our business solidly in the black and to make ourselves profitable and making money. And as we hit the other end of the trough, it's this particular tactic that is going to give us enormous amounts of growth and free cash flow going forward. So, and step one is being able to identify the losers at a granular basis so we can focus on them. All right, Bruce, we have a slide about using the profitable service models, and perhaps you can lead us through that.
Yeah. Can you hear me? Am I on?
Yep, yes.
Can you hear me? Okay. Again, if you think about a pyramid of customers, and at the top you have whales, at the bottom you have zillions, very few of them, and at the bottom you have zillions of minnows. The banks and casinos have the same phenomenon. They have a few drug lords who lose $5 million a visit, and then they've got lots of little nickel slot machine guys at the bottom. Banks have, $30 checking account customers, and they have people who got, tens of millions of dollars parked down there and all sorts of services and so forth. So what we have to do is say, well, all right, where do we draw boundary lines? And the typical bank or casino will have about 7 to 15 strata. And at each boundary line, they'll say, okay, for this next strata of customers, let's increase the service package. And so we'll offer more services, quote, for free. So at the very top, you have all kinds of services, no fees for them. And as you go down, some of the services may still be possible for customers, but they're unbundled for a fee. So freight is extra, type of thing. And so you look at the strata. Now in distribution, I've seen companies that frankly are just brokers. They operate out of an office. They're working 2 phones. They're working on razor-thin margins, and they're betting their receivables, their credit shield from the manufacturers, and that's what they do. There are other people at the other extreme. If you look at a Fastenal store, you go in there, and you drive to the place, and you pick out what you want. You go over and you pay cash or use a credit card, and the margins are, the prices are really high. It's basically a convenience store for emergency purchasing for contracting creatures where time is money. I don't care if it's $10 or $15. I'm going to bill $100 an hour and pass the markup on the product along anyway. But if I can't get the product now from a local convenient place, then I can't do the job, and the customer wants fast service also. So when you look at these different strata, brokerage, traditional full service out of the warehouse, which will include an outside sales and free delivery and stuff like that, wholesale, which is what the Fastenal model is, web order entry catalog, which is sort of what Grainger is. Grainger gets into wholesale also. You find most distributors can do one or two strata effectively and profitably. But after that, the structural things you need for one niche get in the way of another niche. So if you want to be a big volume, low-cost distributor of bulky stuff, you need a big honking warehouse down in a bad part of town. As opposed to if you want to be a wholesaler, you have to be out on a 4-lane commercial highway where you can see the sign and people can pull in and so forth, but not in a mall. That's retail. And so once we understand this, we start to create our boundaries and spool off customers into different, not just industry segments, as Randy was looking, for example, at fast food versus general restaurant. Another slice would be big guys, medium-sized, little guys. Where are those boundaries for outside sales coverage, for example, as opposed to telemarketing, as opposed to catalog, faxgrams or egrams or something. And once we get those pools, we can sum up the pools of profit and loss and see how we're doing in those different customer niches, decide which ones we really want to hyper-focus on and which ones we may get out of, or we could spin them out. But a lot of possibilities once you get the data and the patterns emerge. But that's sort of the concept here of profitable service models, as opposed to when we're financial, sales, volume, reporting creatures. When you look at cost of service, one big, huge thing to run the business, and in hiding in cost of service, quote, fixed costs. We've got lots of fixed costs here. Oh, really? Could you be a little more precise? No. Yeah, it's a mystery. It's big. So we start to just think, well, heck, any customer is a good customer. Any dollar margin is a good dollar, because we had one more margin a dollar, somehow a lot of it goes to the bottom line. It just isn't the case. Distributors turn out to be, most of their expenses are actually variable or very quickly variable in the cost to serve category. So that's why we have to be very sensitive to figure out our best service models and doing a deeper, better job in those service models rather than trying to be too many things to too many people. I mean, one last analogy, it's like if you have 10 distributors in a space and they're all trying to be everything to 10 different customer niches like the Catholites, we're pretty good in a lot of different categories, and if we can, and fortunately everybody else is equally dissipated and generalized, so it's a fair fight in a decathlon, the way they score it and award medals. But in the free market, if you're the best guy in one event, you clean up. You get 50 to 80% of that customer profit pool. Nobody else can, get in there because you got breadth, depth, high fill rates of the right stuff that those people want. You got the service model that's tuned, so you have high value and low cost. That's the difference is profit. And so you find out that where I'm number 1 and 2, I'd rather have, instead of 20% of everything, I only have 50, 60, 70% of a few things. My sales volume might be the same, but actually I'm going to make serious money as opposed to breaking even. And so that's what this slide's about.
Yeah, no, so that brings us to the next topic, and that is maybe one of the most vital, and that is managing on the deltas. It's very, very important strategically to be able to make sure that you're managing things that are actually rewarding you. Frankly, everybody in this meeting is probably paid one way or another, not so much just to do a task, but to make sure that the company is better today than it was yesterday, better tomorrow than it is today. And really, the driving those improvements is what our number one priority is. So we're trying to become more profitable. We're trying to make have more customers, have a bigger territory, bigger footprint, generate more profit for the stakeholders, and to reinvest in the company. And that's really what our underlying job is, and that's what we do specifically is in service of that. And in order to be able to maximize that, you can't just throw a lot of stuff in the air and hope that it comes down that way by doing things that make sense. You really need to hyper-focus on the things that are driving you in that direction and be able to identify the things that are slowing you down and do something about it. And so what we can do is we can take a look at deltas. And so, for instance, we can rank all of our customers by profit delta. And so what we have here is all of our customers ranked for last year's net profit, this year's net profit, and what the difference is. And lo and behold, we start to have some new things that we can focus on. Surprisingly, at the very top of the list of the people that are helping us make the company better is one of our biggest money-losing customers. The reason why? They're losing less money this year than they did last year. So whatever we've done or however we're working with them, however that service model has changed, we've ameliorated over $25,000 in losses here. And reducing a loss to a losing customer by $25,000 is exactly the same to the company as getting a brand new customer that generates $25,000 in bottom line. It's exactly the same thing to the bank. It's exactly the same thing to the company's profit performance. And being able to identify and understand which customers, which reps, which territories, which products, which vendors are helping us achieve our goal of improving profit helps us make sure that we deploy our resources and our thinking and our time and our talent on the things that are making the biggest difference and driving us in the direction we want to go. And at the very bottom, we have customers down here that may be profitable but are less profitable than they used to and are doing the most to detract from our position. They're the ones that are producing the biggest amount of hurt and the most amount of drag in our forward progress. So again, managing on the deltas is a very, very powerful technique to be able to help you make sure that you're goosing the things that are driving you in the right direction and hyper-focus on eliminating the things that are slowing you down. Get rid of those brakes, get rid of those anchors that are down there by transforming them into something that are at least neutral or are less negative than they used to be, especially ones that are providing the most drag. And knowing who they are is absolutely essential. In Waypoint, we can do that for customers. We can do it for territories, for reps, for SKUs. You can look at the profit deltas on a number of different dimensions of the business and be able to instantly get that. And you can do that right down to the branch level or the territory level or even the product category level and find out what the things are that are really slowing you down. And you can get in every operating part of the business, there's information available for the people to be able to manage on the deltas there as well. And managing on the deltas is something that very few companies do. And if your company is one of them, then you're going to leave the other guys in the dust. If you're not, and somebody else does, then you're not going to have the insights that they have, and they're going to leave you behind. So it's very, very important to be able to bring that technique to bear. All right, so there are a number of QPM plays or RPI, profit improvement plays. We have a whole webinar on this, and that will be running again in the next week or two. You'll get information in email on that. But this is just a brief inventory of some of the most popular and effective profit improvement plays that you can use at your business, and we can spend time working with you so that you can learn how to use these things. All of this information is available on Bruce's website, merrifield.com, and we'll be sending the links for that as well. So to sort of start to sum up now, with QPM, there's quite a number of things that you can do as you start to bring this into effect at your company. There's quite a number of benefits that will come out of it. Bruce, do you want to walk us through some of these things?
Well, no, I think that they can read them. I will just point out the very last thing. FedEx's motto, people, service, profits, the theory being if I get really good people and I keep them and I train them and I cross-train them and I skill them up and they're trying to achieve phenomenal service metrics, 0 errors, on-time delivery, unconditionally guaranteed. I mean, FedEx taught us to want service brilliance. Then customers will be happy and stay with us and tell their friends and will become profitable. Well, that's, it's a good theory and it's true. The problem is most people don't know how to capture people engagement metrics, when it comes to service metrics, that doesn't tell you who your number one niche of customers are and what the most popular items are for that particular group of customers and what your current fill rates are and how to tweak those higher and cross-sell more core items to more core customers with a tracking report, et cetera. So what you find is that quantum profit management allows you, you define your strategy, which is where historically you made your money. So you say, oh, it's the core and it's the anti-core, and so I'm going to manage on the extremes. But as I really get deeper into understanding my core customers, I'm going to do a lot more work to define my service value metrics equation for that niche, with the keystone being, the best fill rates on the right breadth, depth, one-stop shop in local stock, highest fill rate than any other competitor for that niche. And then that allows you to start to do the rest of the service metrics and the people engagement metrics that flow into that. So there are sort of two vectors, if you will, that kind of come together with QPM, and maybe you didn't call it balanced scorecard reporting on the people service profits part, but another day. Next slide.
All right. So to sort of wrap up, what we have is the QPM principles. You're making more money than you know. We saw the whale curve. Everybody business has one. You do too. And you have a lot more profits than you're seeing right now in the accounting system is showing you. And being able to understand and capitalize on those is really a key to QPM. You want to measure and evaluate at the quantum level. You need to be able to dig deeper if you want to be able to find the diamonds and the drains that are causing problems from the business, and to be able to do something about them. The first thing is you have to be able to identify them. In order to do that, you have to have some real good, solid profitability information that accounts for all of the services that you provide, and so that reflecting the service models that you have in place. Manage on net profit, because it's the only thing that matters, and managing on gross margin can be hugely dysfunctional, can get you in the ditch very quickly, and there is a better way. Manage the deltas, because that's what matters. There are products, vendors, reps, territories, and customers that are driving you in the direction you want to go, and there are those that are holding you back. Being able to recognize one from the other is the first step to be able to make sure that you're taking the brakes off the operation, and you're free to let the entire engine horsepower get to the ground. Make sure that you stay away from using financial averages. Dig deeper, because they'll mask what's going on. They'll hide realities from you, and you won't be making good strategic decisions if you can't get deeper than that. Understand and manage the service models. That's the key. Ultimately, what you need to do is continue to give the gold-plated service to the gold-plated customers, and you need to free up resources that are being consumed right now by customers that just simply don't provide the gross profit budget to support the business that they want to consume. And you can work with them to transform them into customers that have a service model that is appropriate to their gross profit budget, and that will free up profits and cash flow in the business. Make sure that you identify and stop non-strategic cross-subsidies. Make sure that you don't have profits being made someplace that are being wiped out by losses in certain areas that you didn't intend and you'd like to get rid of. And then make sure that you synchronize goals and incentives across the company so that people are incented to understand CTS, understand managing the deltas, understand where the profits come from and where the losses are, so that you can bring the combined brain power of your entire organization together in a meaningful way to start to transform those things. It's the thing that's going to release the anchor from your business and allow you to sail forward. There's some do's and don'ts, but they're kind of reiteration, and we're going to send you this slideshow, by the way, so that you can use it to repeat this for your own people. And by the way, we'll also be happy to provide at no charge a repeat of this for individual companies that want to bring their senior teams together and be able to share the message. Bruce and I would be happy to do a company-focused 1-hour version of this for your own team. But you'll have this as a tool that you can use to start communicating this thinking within your organization. Waypoint Analytics, a brief on this. Waypoint Analytics is an online system that people subscribe to. We harvest all of your transaction data, all of your invoices. We also collect your P&L information, and we integrate one into the other in a very granular and detailed way. We have the most powerful profitability calculation engine going in terms of both the custom-built hardware that supports it here and some unique and proprietary software that helps us do the job that simply nobody else can do. And the key to being able to get all of this profitability information is the fact that we actually cost out every line on every invoice right down to the granular level. So on every single invoice line in your transaction pool, when we're finished with it, we'll have a complete P&L on that line, and we can roll those up to the territory, to the rep, to the SKU, to the product category, to the vendor, to the customer, and get very detailed and very, very accurate cost and profitability information and all of that. This is a low-cost service. People subscribe to it on monthly fees. This is not millions of dollars. This is not hundreds of thousands of dollars. This is thousands of dollars. And we have companies all the way down to about $5 million that use this service. There is nobody that doesn't make back more money than they pay, and a lot more money than they pay. And we know that because we work with the customers, and also we've never had a customer leave us. The business is about 2 years old. We've never had anybody started with Waypoint that decided that they didn't need it or weren't getting anything out of it and stopped the service. So I don't know that that'll go on forever, but it's a nice thing to be able to brag about now. At any rate, it's fast and inexpensive to implement. A record implementation about 2.5, 3 weeks. Some people take maybe 4 or 5 weeks by the time they go back and make all the tweaks they want to make and make sure that everything is integrated. But this is not a 3-month or a 6-month or a 1-year project. This is something that happens almost immediately. And then part of our service envelope, because remember, I'm in business too. I want to sell this service to customers. I have to provide real value. And people are not going to continue using the service if they're not getting insights into their business that are helping them translate into profits. And not everybody knows what we know or has practiced what we practice or knows all of the tactics and strategies for being able to do this. And because of that, we make Bruce and myself available to our customers to spend time with the senior teams looking at their own numbers and coming out with strategic plans to be able to go out and transform the businesses. This is something that makes us unique and I think uniquely valuable. And so when you are a Waypoint customer, you get the full benefit of all of our knowledge and experience in helping you translate the numbers that you will be able to see in Waypoint into strategies, tactics, and actions that will run within your operations that will immediately transform the profit picture of the business. All right, we can open it up for Q&A. We have a couple of minutes left before we hit the 90 minutes. Bruce and I routinely will stay on if other people are interested in having questions or have other things they want to discuss. I will let you know that we have a whole series of webinars. We have the tactics webinar. It talks about all the specific tactics for improving profit. We have a sales compensation design webinar that talks about how to put together a sales comp program that's based around net profit and what the benefits and pros and cons of that are. And we have some other webinars in the offing. We also have coming up in June an on-site seminar in Phoenix for 2 days where people that are charged with profit improvement in their organizations can fly out and spend 2 days with us and some other experts looking at how to do profit improvement programs within their companies. And you'll get information on that as well if you'd care to attend. At any rate, any questions, comments, suggestions, anybody that would like to know more or think something they heard either doesn't make sense, needs amplification, or maybe you think it's total BS and you want to challenge us? Anyone? If you have us on mute, by the way, don't forget to unmute your phone before you speak up and ask your questions. All right. Well, I want to thank everyone for coming in this morning. I would be happy to, as I said before, we can set up a 1-hour session with any of you at your companies to repeat this for your senior team if you would like to know more, or you'd like to have this message carried in your own company. There's no charge for that. We also can set up a 1-hour session to show you more about Waypoint. And you can bring your, CFO, CEO, sales VP, CIO, creatures into this meeting, and they can ask their questions, have their challenges, and see if there's ways that Waypoint can benefit your company. We'd be delighted to show you that as well. There'll be information on both of these things as a follow-up. And as one last item, Bruce has a course on the profit improvement tactics and strategies that can be used for your own information and ideas. It's an 11-hour course on DVD. Comes with a big workbook. Can be used for training, whatnot. It sells for $1,000, but people on the webinar can order it for $300. And there'll be information on that in the follow-up as well. All right, I want to thank everybody for coming in today. It was delightful being able to share this QPM wisdom with others, and we do hope you'll be able to carry it back and translate it into profits in your business. I'd be delighted if Waypoint was part of that equation, but if not, I wish you all the best of success, and I'd like to see you on next time around. So thank you all for coming, and we'll talk to you next time.